Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead. LME 3-month copper. The late February to late March bullish Andrews pitchfork, highlighted in dark blue on my daily chart, drove this market higher throughout April and into mid-May, making new all-time highs. However, this beautiful, if very acute, bullish Andrews pitchfork eventually shot too high and made a V-top over the middle of May, initially punching up through the top of the pitchfork before turning back down and busting down through the bottom of the pattern. Below at the time was the previously often mentioned congestion zone, 97.50 to 99.95. This time on the way down, the market did not really hesitate, as it did back at the turn of April into May on the way up, but punched down through it and also down through the green highlighted short medium moving average, currently at 99.15. Below now is the next congestion zone between 93.95 to 96.06, with a smaller one thereafter between 91.83 to 92.56. Between these two congestion zones is the medium moving average, currently at 93.14. In the process of moving lower, the market exited one pattern and straight into another, from a bullish Andrews pitchfork into a bright red highlighted narrow descending wedge pattern, currently at 94.17 to 97.72. Both this and the bullish Andrews pitchfork are quite acute patterns. So, until this bright red descending wedge pattern is broken or morphs into another pattern, then it will be the one that runs the move lower. However, under the medium moving average, we have the 50% Fibonacci line for the July 2022 to May 2023 move at 90.29. And under this, near the long moving average, currently at 8800, is the 50% Fibonacci line of the October 2020 to May 2023 move. And that's, well, either of these two would actually seem a suitable place for a halt and maybe start a new pattern or a new idea. LME 3-month aluminium. Now please excuse the red highlighted text on my daily chart. Sometimes my charting package decides to throw a wobbler for no apparent reason, and this is one of those times. So the red text is not necessarily anything special. So back to the aluminium market, and the move higher over March, April and even May originates back in late February, with the market breaking higher from a diamond pattern type formed between late October 2023 to late February 2024. Now, I grant you, it was not the best looking diamond pattern type, but as I said repeatedly back then and ever since, it had merit. However, the market took its own sweet time in moving up to the topside targets, but get up there they did. The next feature was the big spike higher on the 15th of April that ended up as an indecisive Toji cross of all things. This huge move showed the topside potential of the market for the next few weeks. As part of this move higher, we had a gap move up over the weekend between the 12th and the 15th of April. We spent the rest of April and early May gradually moving down to fill in this gap, which was done early 5 weeks ago. Prices then started moving back up through the high on the 15th of April at 27.28. 3 weeks ago, the market made new recent highs, but at the same time sowed the seeds of its own bullish destruction by making a 2-day pipe top that was also part of a larger 2-week horn top. We've moved down ever since. Now the move lower, which includes a small bearish half hesitation, formed at the start of June and was in the shape of a descending wedge pattern, currently at 24.49 to 25.27. It is quite narrow and very acute. Because of these factors, I've chosen not to highlight it on my daily chart, as it would obscure the pattern of the market. Price is now entering a wide congestion band between 24.37 to 25.15, which looks quite a disconnected zone, but in truth does work together. What is most important about this zone is that it is the beginning of a move down from the second of the two patterns. It's a large mid-April today possible double top pattern, Adam and Eve type. I called it a potential pattern as the neckline for this double top is around the 2508 to 2515 area, and though we have penetrated, we have not as yet, though maybe today, we have not as yet had any consecutive closes below it. But if it does, then this pattern will, as I said last week, and I quote, will determine the next phase of this market. However, without formally calling them as potential pattern targets, I can give some idea of the destinations of the moves should they be confirmed in the coming week. Thus, the primary target will be in the 2400 zone, with a secondary hard to reach destination down in the 2000 zone. I've had a little think about that. I think it's too optimistic to look it down at 2000 zone. Let's say a secondary harder to reach destination zone in a 2300 zone. LME 3-month lead. I said 13 weeks ago here, and I quote, I suspect the key overhead resistance will be the same as in late January, the congestion between 2182 to 2189, end of quote. Please remember that quote, or rather remember that 2182 to 2189 level, as it will become relevant again. Okay, so the elephant in the room, as I have been calling it for 5 weeks now, is the bright red highlighted mid-February to late March bullish Andrews pitchfork. In late May, the market breached the upper time, currently at 23.93, but it repaired itself, or so it seemed. The breach allowed a bearish inflection to set in that ended up being a horn top, which was the high point of this recent move upwards. Into June, we have seen prices fall. 2 weeks ago, the market breached the neckline of the horn top, but by the end of that week had punched down through the congestion from around 2 significant 50% Fibonacci supports. The one for the whole of 2022 at 22.25, and the one for the June to October 2018 move at 22.21. In doing so, the market had also reached the primary target for the horn top at 22.15, and the secondary hard to reach target in the 21.73 zone. Last week's drive lower moved down towards the next congestion, a wide band from April between roughly 21.86 to 21.35, which has 3 50% Fibonacci lines within it. The November 2023 to May 2024 move at 21.76, the May 23 to May 24 move at 21.67, and down at the low end, the March 2020 to March 22 move at 21.35. In addition to these, we also have the bright red lower time, currently at 21.79, plus the mauve highlighted medium moving average, currently 21.55, and gold highlighted long moving average, currently 21.44. The process of driving lower the market formed an acute, narrow, dark blue highlighted bear channel, currently 20.88 to 21.63. I said last week, and I quote, till prices break out of this dark blue bear channel or morph into some other pattern, then this bear channel will run things, end of quote. I then proceeded to give details on the lower time and the 2 moving averages. Well, this week, indeed today, the market has staged an attempted breakout. It's only day 1, but it's enough to show the strength of the whole combination of supports between 21.86 to 21.35. The questions for the coming week will be 1. Is the move back up sustainable? And 2. What pattern will now develop? Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.